Hello, everyone. This is our little session to talk about the upcoming final quiz. And unfortunately, I screwed up the class schedule. So thanks, Nicole, for letting me know that we were not supposed to schedule class on the week of November 30th. So instead, you guys have a chance to review this wonderful video. So I'm gonna try to do this in one take, so bear with me if I stumble and fumble a little bit. Earlier today, we had what I thought was a real good interview with Alan Wright with CLA, and he talked to us about investing, and also more specifically, we talked about mutual funds and ETFs. I recorded the video, so go to Canvas. I think it's 14, I don't know. It's in module 14, I think. But just go to that and check that out. Good information from Alan, great advice, great recommendations. So if you didn't have a chance to meet with us live today, then you definitely want to check that out. Good information. So this final quiz, let's talk about this. And let me go to my screen share. So this is available to you guys via Canvas. So the final quiz, the third quiz in this class, will be on Wednesday, December the 2nd. And it'll be available, this is actually incorrect, it'll be available at 8 a.m., but I'm gonna cut it off at 8 p.m., so 8 to 8. And you'll have 90 minutes. Very similar format to what we had for quizzes 1 and 2. 20 true-false questions, 20 multiple choice questions. And these questions will only be from chapters 11 through 15. So the topics will be health insurance, life insurance, investment basics, stocks and bonds, and mutual funds. So to prepare for this final quiz, review the PowerPoint notes that are posted in Canvas 11 through 15. Go through all the assignments, watch the videos. If there was any information that I sent via any emails, weekly recaps, anything like that, double check those. And here are some of the topics that will be, may or may not be covered in the quiz. Just kind of gives you a rough idea. But make sure that you do check out the notes and also read the material too. Hopefully you've already read through each of these chapters. So all you have to do is just go through the notes as a refresher. So let's go through this information. The ACA, the Affordable Care Act, what is it? Age limit coverage under a parent's plan, what's the individual mandate. So I'm gonna quickly go through each of these and tell you a little bit about each one of these items, but for more detail, you definitely need to go through the notes and go through the information in the book. So the ACA is our attempt at universal healthcare insurance. And it was originally put together to pool everybody's resources and to really try to cover those folks who did not have health insurance through their employer because they were out on their own or they couldn't afford it. But the basic idea was to provide health care for everybody. And so there were some great benefits to that. The ACA, for example, the pre-existing coverage that you guys have probably heard so much about, that no matter which direction we go with healthcare in the future, hopefully we'll all be covered for pre-existing insurance coverage, which means that insurance companies cannot refuse to cover you because you have a pre-existing medical condition. So that was a major change and major feature of the ACA. The age limit that you can be covered under your parents' plan is 26. And there was something originally called the individual mandate, which meant that it was a requirement that you have healthcare insurance. And if you didn't have it through your employer or through the government, then you needed to have the ACA. And if you didn't sign up for this, then you were charged a penalty. So that was the individual mandate. It has since been altered so that there still is an individual mandate, but there is no penalty. There is no dollar amount that the IRS is going to ding you for. So anyways, that's down and dirty, the ACA. Copays versus co-insurance, they are two different concepts. A copay means that whenever you go to the doctor's office, you're going to pay a small fee. It could be $10 or $20 or $50, but you're going to pay every time you visit, versus co-insurance, which means once you hit certain levels, deductible levels, then co-insurance kicks in, meaning that you're going to pay a percentage and your health insurance provider will pay a percentage. So usually it's an 80-20 split. So you satisfy your deductible and then co-insurance kicks in, meaning that the insurance company pays 80%, for example, and then you pay 20%. Disability insurance is insurance that covers your loss of income if you are disabled. A high deductible health insurance plan. A lot of the health insurance programs that are on the marketplace for healthcare have high deductible health plans. So they're trying to keep the premium somewhat low or lower by having you, your families meet real high deductible levels. And once those deductible levels are met, then the co-insurance or the other insurance benefits kick in. Who is the insured? The insured is you. It's the person who has signed up for that particular type of insurance. So versus the insurer. The insurer, ER, is the insuring company. The insured is the person who is insured. What is a beneficiary? It is the person that's been named by an insurance policy to benefit from the insurance policy. So in life insurance, the insured is naming beneficiaries. So when the insured passes away, then the death proceeds then would go to the named beneficiary. One easy way to remember what this is about is beneficiary, just think of benefit, who is benefiting from that insurance, and you name who those people are. So usually the spouse or the children. Understand the difference between stocks and bonds. Stocks are ownership, bonds our debt. And stocks are riskier, but they have a greater overall return over time. Bonds are more conservative. They're also called fixed income, and they pay yearly interest. Stocks can also pay dividends, which are annual or semi-annual payments based on the profitability of the company. Financial risk, we talked a lot about this. Obviously, the greater the risk, the greater the reward, generally speaking. What are dividends? Dividends, as I just mentioned, are profits in companies that are shared by the companies to the shareholders. Diversification is really important to make sure that you have a nice mix in your portfolio of many different products, stocks, bonds, and maybe some commodities, private equity, mutual funds. Mutual funds, as we just talked about with Alan, in and of itself are a way to diversify because mutual funds have a basket of stocks and bonds and other securities that kind of spread out the risk, as opposed to buying one or two stocks and then having kind of all your eggs in one basket. You don't want to be in that position. Deductibles, talked about this. The deductibles are the out-of-pocket money that you have to pay before your insurance kicks in. Medicare versus Medicaid. We didn't really talk a lot about this, but Medicare is health insurance that is paid by the government once you hit age 65. So it provides our elderly folks with insurance coverage. Medicaid is a government program for those who have special needs or they have issues with affordability and being able to pay for insurance, based on their economic situation. What is the purpose of life insurance? Really it has several purposes, but for the most part, it's protection for your family to make sure that if there's a loss of life, that income needs for that family can be maybe not totally replaced, but can be provided to the family so that there is some relief. And so I'd say the purpose is number one, protection. There also is an investment component to life insurance as well, which can provide loans against your life insurance. It could provide some cash buildup, what's called cash value, which is a nice segue into the next section, talking about the difference between term and whole life or permanent life insurance. Term meaning just covering the loss of life. Term is cheaper. It's like renting versus owning. That's not to say that it's a bad thing. In fact, a lot of people like Dave Ramsey, if you remember the videos, was a very big proponent of buying term insurance because it's just pure insurance covering your life, loss of life, versus paying a lot more for whole life or permanent life insurance, which has an investment aspect to that product, and that money is invested, and so that there's a buildup of cash value in that policy. So that's the difference there. Capital gains are gains that you make in the stock market or in any type of investment where you buy at hopefully at a low price and sell at a high price, and that gain you are taxed on. Once you sell it, though, that's the key to understanding capital gains, is once it's sold. What are securities? Securities is the big umbrella that includes stocks, which are also called equities, stocks and bonds, and all the different types of funds, mutual funds, ETFs, public corporations, and the issuance of stock. So any company that is on any of the various markets, so the stock markets, are public companies, meaning that the public, you and I, can purchase ownership in those companies. And a lot of public companies will issue stock in order to raise money. So they issue stock, which is ownership in the company. We pay them cash, and that cash goes to the company so that they can expand and they can grow their business. And if they're profitable, then they're able to return money back to the shareholders. Who issues bonds? Bonds, as we've talked about, bonds are debt. And there's several entities that issue bonds. Corporations can issue bonds in order to raise money. Government entities, the federal government has bonds, and local and state and local municipalities issue bonds so that they can raise money to help with infrastructure and to build resources that help the local communities. What's the PE ratio? That's the price to earnings. So it's the price of the stock over earnings. And I made a little note here. So maybe take the EPS first. So the EPS is the earnings per share, which is just the overall profit divided by the number of shares to specifically pin down what the earnings are per share of stock. And so that's an indication of how the company is doing, especially if you measure that over time to see if its earnings are growing. And as I mentioned before, that is one of the key measures of determining the overall value of a company or value of a stock is how the corporate profits are doing. So the price to earnings ratio, once you know the EPS, the earnings per share, then you would take the price of the current market price of the stock, and you divide that by the EPS, so the earnings per share, and then you would have a number, and that number really indicates how expensive a stock is as it relates to its overall earnings. So another good measuring stick for stocks, probably the two most used, calculations to determine the value of a stock, the price to earnings and the earnings per share. The beta measures volatility. So a beta of 1 is kind of like that's kind of the neutral point. So a beta greater than 1 indicates more volatility in that particular company or that particular traded stock. Anything less indicates a little bit more stability. So it's just a measure of overall volatility. The blue chip stocks are the stocks that are, the big, well-established a lot of bricks and mortar companies that you guys would all recognize. And some investors like to just put their money into the blue chip stocks because it's predictable, and while they may not have the great crazy double-digit returns, they can pretty much count on these blue chip stocks delivering consistent dividends as well as stock appreciation. Index funds are funds that follow the various market indexes. So they try to correlate the purchases of stocks and bonds based on various indexes and try to mirror those indexes. Indexes like the New York Stock Exchange, or the S&P, the NASDAQ. Mutual funds. We spent most of the discussion today with Alan talking about mutual funds and the advantages of mutual funds. And most 401k plans will provide you with mutual fund options, and you will probably take a very similar risk tolerance questionnaire that we talked about earlier. So depending on where you're landing as far as your overall risk tolerance, there will be recommendations for you to select which mutual fund to go into. So mutual funds are just baskets of grouped together stocks and bonds, and maybe some other securities thrown in there. As Alan said, some mutual funds have hundreds and hundreds of different stocks and bonds kind of built in there. And again, the idea is by hand-picking a bunch of these, the stocks, and these are managed by fund managers, then you have the advantage of having diversification built into those funds. And some mutual funds are riskier than others, but it just kind of depends on what your risk tolerance level is. Loads are the commissions, the fees that you have to pay out in order to own mutual funds. And you just have to be careful with these loads, because some are front loaded, meaning that they charge you on the front end, some charge on the back end, some charge when you sell. There are some no loads, which are great because there's no fees, but so you just have to know what you're getting into, because those fees could cut into your overall profitability or your overall performance. So it's important just to know what you're dealing with. All right. So like I said, that's that's a kind of a good start, a good idea of some of the key topics that may or may not be covered on the quiz. Go through the chapter notes and the assignments, the videos, and I think you'll be in great shape. Certainly, if you have any questions, then let me get out of share here so you can see me. If you have any questions, then let me know, and I'd be more than happy to set up a Zoom or WebEx one-on-one session. We can talk more specifically about your questions. So I'm available anytime. Just let me know. All right. Well, good luck. I'm sure you guys won't have any trouble with the final quiz, but certainly reach out if you have any questions. I'll also make sure, like I did last, I think before the midterm, I'll send each of you individual emails letting you know where you stand. So once the grades come through from the final quiz, I'll tally up your assignments and kind of see where you stack up with the 3 quizzes, the assignments. And so before I submit final grades, you'll have an email from me with a recap of where you're at. Then you could respond or not. If I'm missing something, then we can talk about it. So I'll make sure that each of you guys get that before I post final grades. Anyways, that's the wrap. Hope you guys have a great Thanksgiving. And again, let me know if you have any questions. And if not, talk to you soon. Bye.